right now? Can you use conventional Michelle Meyer economics to look forward, or do you have to make it up as you go?
So I think what we've learned is that right now it's really important to do a bottoms-up exercise, a bottoms-up modeling, right? Because the shock is so sector specific and it's hitting the economy in many different ways. So think about it for jobs, for example. Probably the best way to forecast the path forward for the labor market and the unemployment rate is to think carefully about each major sector. How are retail jobs going to recover versus construction versus autos versus leisure and hospitality? And from that, you can then kind of add up and think about the big picture. But it's really important to look at the economy on a sector-to-sector basis right now.
I agree with that. In the partition of goods and services, we've seen goods disinflation and outright deflation at times. Do you suggest we will see service sector disinflation?
Look, this is a service sector shock. And you're right. Typically, it's goods that swings around a lot more. It's goods that tend to be the most vulnerable in a recession. But consider the consumer basket that we've seen in the past few months since COVID hit. People have been spending on durable goods. They've been spending on household appliances. They've been spending on autos. They've been spending on housing, and they haven't been spending on services. So the big demand destruction has been much more on services. Now, part of that comes back. It already is coming back upon reopening, but not fully. So the bigger price adjustments happen to services. I don't think you'll see outright deflation for broad services because the lodging component, the rental component in there is so broad, but we're going to flirt with that. And certainly many categories will be disinflationary and some will be in deflation territory.
Michelle, I'm going to steal from your research the three phases to all of this: the shutdown, the bounce, the recovery. You've talked about that bounce off the trampoline followed by a long climb up a rope. What are you learning from the bounce in the last month?
So, I think it's been stronger than maybe we would have anticipated. And part of that because the reopening was also earlier. So it's happened earlier. It's been strong. Consumer confidence has also picked up pretty meaningfully. So people also feel better about the world. There's clearly a desire to re-engage. That said, we're now starting to see very early evidence that things are leveling off, whether you look at it in terms of some of the high frequency data around consumer spending or small business openings from a variety of alternative data sources as well. Things are starting to kind of peak out, particularly in the states that are further along in the reopening process. So that tells us that next phase, and thank you for referencing those three phases, that next phase, the true healing and the recovery phase, we're starting to approach that. And that's going to be a much more challenging one, in my view.
And Michelle, another challenging aspect here is the road ahead for housing. So far, we've seen amazing resilience. And I know this is one of your expertises dating back to 2005, 2006. And I'm wondering how long this can last if we don't see a further resurgence, especially since these are really being driven by mortgage rates at all-time lows.
Yeah, I think for housing, clearly the bounce has been incredible. Mortgage purchase applications at an 11-year high, new construction in particular benefiting the most because of the ability and the ease of searching for new construction versus existing. So mortgage rates, I think, is one factor. I think pandemic-related relocations is another factor, particularly out of urban areas. We've seen a lot of survey evidence to that effect. And then the demographics in general have been also favorable for housing. And this factor continues. So no, we won't expect this rate of growth to persist for housing. This is a sharp move up given the situation. But the fundamentals are still pretty supportive. And if we could assume, and I think rightfully so, that interest rates are going to remain very low for the medium term, housing should continue to be underpinned.
Michelle, when you talk about the migration out of urban areas, is it going to leave zombie lands in some of the big metropolitan areas where there's an incredible amount of commercial real estate that won't necessarily get filled up, as well as residential that's been built up over the past few years?
So I think there will be some real consequences, of course, from these considerable shifts in population and where people want to live, where people want to work. But remember that they're short-term adjustments. In the end, urban centers are still vibrant. It's still where, the heart of businesses tend to lie. And these cities, particularly if you think New York City, they've been through these shocks over the years and they do bounce back. But I do think in the short term we will be seeing a pretty meaningful adjustment. And if you think about even just the real estate market in some of the cities versus the suburbs, you're already starting to see some of that price convergence even before COVID hit. So the COVID shock just amplifies what was already underway in terms of the migration paths.
Michelle, there's a real worry that the infection increase of the last several weeks in several states, including Texas, is going to constrain the reopening process and start to hit the data. My worry, just looking at this from an economics perspective, is that the sequential improvement is bound to continue because places like New York are just starting to reopen.
Right.
Those forces will be really powerful. So the aggregate numbers over the next couple of months might still look strong. Do you think that could mask some fragility underneath, and we might miss what is happening in places like Texas, California, Florida, and elsewhere?
So you're absolutely right in that, when you think about the aggregate, you have the states that are further along in reopening where the viruses are rising. Things might be starting to slow there because just the length of time post-reopening, and now they have the virus concerns. But that's going to be offset by New York, New Jersey, Massachusetts, moving into the reopening process, further along in the reopening process. So that's why it's absolutely critical to look at high-frequency data on a state basis. So we do a lot of work where we're trying to pick out the states, kind of bucket the states into the degree of reopening and track daily, weekly data in terms of understanding what economic activity is doing. And I think the most important indicator will be if the states that are further along in reopening that now have viruses on the rise, as you said, Texas, Florida, Arizona, I would also put Arizona and South Carolina in that bucket. If you start to see behavior switch, even before there's government policies that demand that, right, just from personal preferences, I think that will be a very important sign.
What should we look for in the high-frequency data tomorrow morning at 8:30, the claims statistics?
So we love claims. Claims are a great piece of information, but they are flawed, and we've learned that. They're flawed in part because there's backlog issues, presumably, in terms of how to process these indicators. There's all different changes to the claims programs in terms of eligibility and criteria for receiving claims. So I think you need to take them with a grain of salt when you're translating those claims numbers into actual hiring and more important, firing really is what you're capturing with it. That said, the stickiness that we've seen from claims has been a sign of a reason to be concerned, because it tells you that there's still some firing going on, even when we know there's hiring from reopening. So for claims tomorrow, we do think we're going to see some modest move down in initial jobless claims remaining above 1 million. And continuing jobless claims, which is probably really one of the more critical indicators when you're trying to map this to an unemployment rate. I would imagine it comes down a bit, but I don't think we should expect these dramatic falls right now in claims. Certainly the data hasn't shown that.